welcome to the Simply Financial Podcast. I'm your host, Christopher Calandra. Want to increase your financial IQ with today's discussion, which is about behavioral finance, sort of a primer. This is part two. I would encourage you to listen to part one if you haven't done so already. On that episode, I talked about three things: anchoring, confirmation bias, and recency bias. Today, I want to talk about three: hurting, ambiguity aversion, and myopic loss aversion. Wow, that sounds pretty complicated. It's not too bad, though. Let's talk about hurting first. Hurting is behavioral finance, which talks about the tendency to follow others, follow the actions of the crowd. I'm reminded of what my mom and my dad would say when I was a kid about, would you do it if they jumped off a bridge? Would you follow them if they jumped off a bridge? So hurting is the tendency to follow the actions of the crowd rather than making independent decisions. This is a phenomenon where people simply base decisions on the behavior of others, assuming that the large group sort of knows what they're doing and they're making good decisions. It's a hack, if you will. You figure that if everybody's doing it, everybody on balance must know what they're doing, and it's a good decision. These hurting tendencies can lead to movements that are exaggerated. It could even lead to what are called bubbles, where you have maybe prices bubble up in something just because people pile in to a particular trade or an investment or something like that. With hurting, there's also an element of FOMO, the fear of missing out. I think that is a part of the hurting behavioral finance situation. And again, I'm reminded of my parents. If everybody jumped off, would you follow them too? So there is a contrary kind of approach called contrarian. I kind of gave it away, where sometimes investors, or sometimes you can be wise by taking the opposite approach than the crowds. I tend to be a little contrarian in many things in business and elsewhere. So that's sort of a personal bias for me. It doesn't work all the time. It has its flaws too. But I tend not to be a hurting person and more of a contrarian. That's me. The next thing I want to talk about is ambiguity aversion. And this is like many of the things we've talked about before. It's sort of part of our mental makeup, just kind of how we are constructed as human beings. And what ambiguity aversion is, it's the preference that we have for situations with known probabilities. We will gravitate to certainty over uncertainty as a general rule. And so we will pick, if we have a choice between a known probability over an unknown or ambiguous probability. So as an example, a classic example would be, a lot of people would choose a fixed rate of return on something as opposed to an investment that might have tremendous upside and maybe some downside below the fixed rate. A lot of people, based on just how we're hardwired, will pick the fixed rate simply because it's the known probability and have an aversion, will shy away from an unknown or ambiguous probability. So this is something that you want to be mindful of, like the previous four I've spoken to, the three in part one and hurting in this episode, because it could lead to undesirable or underwhelming decisions. You have to be careful when investing with money management and even with decisions about risk in business. You know, things like buying equipment, expanding, hiring people, starting a new division, starting a business. Sometimes people can be too averse to the unknown, and they might do so in such a way that turns out not to be beneficial. So that's ambiguity aversion. And the last of the three things I want to talk about today, again, part two, check out part 1 if you haven't done so already, is myopic loss aversion. So it takes into it brings together two things in psychology. The first is short-sightedness. We have a tendency to focus on the short term. And this is related to one of the things I talked about in episode 1, the recency bias. We tend to be short-sighted. And the second thing, aversion, which I talked about just a moment ago with ambiguity aversion, is that you can prioritize the short term over long-term considerations. And when you are investing, building wealth over time, it is often said that investing is mostly about time in the market as opposed to timing the market. A lot of investors will focus on the timing of the market, what to buy, when, what to sell, what sector to be in, what's the new hot trend, hot stock, that kind of thing. But there's lots and lots of academic research that shows time in the market is way more important than those individual decisions. That's not to say they are not worth the effort. They are. But the bigger thing is being in the market long term. So myopic loss aversion is simply having too much of a focus on the short term and prioritizing the short term over long-term considerations. So there's lots of ways this is expressed. I just described one about being short-sighted in investment returns and being in the market, especially during downturns, which happen inevitably. It's just part of what the market delivers. What the market also delivers based on historical data is good returns over the long term, even taking into account these common and significant downturns. So that's myopic loss aversion. So we covered herding, ambiguity aversion, and myopic loss aversion. Those are a mouthful. Hopefully I explained it a way that's easily understood. That was my goal. Thanks for listening to today's episode. Usually at the end, I ask for two things. Number one, check out my website, elliottwealth.com. You could see about the work that my team and I do here at Elliott Wealth Management to help our clients win with money. And the second ask is to subscribe to the podcast if you haven't done so already. You could also recommend it to a friend. I would appreciate all of those things. Thanks for listening today. I'll be back with you on the next episode of the Simply Financial Podcast very soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.